Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. This is Daybreak Asia. I'm Doug Krisner in New York, joined by my colleague Avril Hong in Singapore. And our guest is Cheryl Smith. She's economist and portfolio manager at Trillium Asset Management. Cheryl joins us from Boston, Massachusetts. Thanks for making time to chat with us. I'm sure you've had a very, very interesting week with a lot of the volatility that we have been seeing in markets. Late in the day yesterday, I was struck by the fact that JP Morgan put out a note indicating that, according to its calculations, the unwinding of this yen carry trade, which really created an enormous amount of this week's volatility, has been essentially removed, has been unwound, 75%. Does that make you feel a little bit more comfortable at this point, Cheryl?
It feels more comfortable than knowing that there's a huge amount still to be unwound, but it is the sense that when you have market instability, you begin to discover the trades that you didn't exactly know were there. So I think it was something people knew, that there was a carry trade going on. People knew that it made sense because the stability of the difference between U.S. interest rates and Japanese interest rates had been established for quite a long time, and the exchange rates were relatively stable. What we did not know until we saw the unwind coming was really how large that trade was, how many trades had been placed, and how levered they were. So how susceptible the traders were to any unexpected change in either the interest rate spread or in the differential the direction of the exchange rate. So the speed at which that happened was quite alarming, you should say. So I think, 25% left to go is certainly better than looking and saying, oh my gosh, there's 3 times more to go.
Cheryl, when we look at where the yen is seated now, it's around the 147 level. It's nowhere near the 141 we saw intraday earlier in the week, which also tells us that the Fed is a driver in a way of what we see on the pair, given what we got out of the U.S. initial jobless claims declining by the most in nearly a year. What are you expecting out of September?
I think that I still expect to see the labor market deteriorating somewhat, because while the initial claims fell by the most in quite some time, continuing claims were steady and are 40% above where they were at their low. So we really have a substantial backlog. That continuing claims, I think, is a little bit more of an indicator, because it includes people that have been out of work for a longer period of time. And what we're seeing is that people are finding it harder to get jobs. Maybe not so much coming in, losing jobs immediately, but that longer duration of unemployment still counts and still brings up a rising unemployment rate.
What is your sense of whether, they're going to try and completely put the genie back in the bottle? Are we still talking about 2% on the inflation target?
They certainly have been very, very steadfast that is where they are trying to go. And a large part of inflation is expectational. People try to put that in their labor contracts. People put it in their expectations of how are they doing. And we had an established 2% or lower inflation rate for a good 10 years. And the Fed, I think, is trying very, very hard to get that back into people's heads, to get that back into people's minds, and therefore into people's behavior. So they need to keep, in their mind, aiming for that 2% target, and I think that they will continue to do it. I don't think that they think that this amount of increase in unemployment that we've seen so far is out of line. I don't think that the Fed thinks that it is behind ball.
It seems like you disagree somewhat, and if that's the case, are you expecting a recession?
We are expecting a recession. We are not expecting a super deep recession, but we are expecting a recession. They tend to be cumulative. So when you see this increase in continuing claims, those people run out of resources or their resources are strained. They spend less. That spending less really doesn't do it on its own. But as consumers spend less, businesses start cutting their discretionary spending. They cut the investment. And that is what really can cause a recession to gather hold and start really rolling. So we've seen in this earnings season, we saw a lot of discussion, particularly about AI. How much investment were firms going to make in AI, and were they ever going to see a payoff? Those are the kinds of questions when shareholders start asking those questions, business people start looking at their investment plans and, can I take a little out here? Can I take a little out there? They may still commit to large scale commitments like investing in AI, but where else are they going to cut? So as we see those questions about returns on investment coming up, businesses get happy to sort of pull the trigger and cut investment plans, and that's what starts to snowball. So that's really my concern.
Cheryl, I take your point about, things slowing down, especially when it comes to earnings and, AI spending. It really needs to show that it's a revenue generator. But in terms of the recession risks, given how big the reaction, the concern, in the market was earlier this week, it seems more like an overreaction, to me at least. What is your sense of whether it was just a case of, perhaps bad timing, given how it coincided with tech earnings and the rotation, and then we also had concerns about tensions in the Middle East?
I think this initial rapid drop, and certainly what we saw in Japan, was I won't call it an overreaction, but I'll call it an immediate marking to market, if you will, an immediate change in expectations. And I would add into the factors that you mentioned that we really did see. The market certainly perceived a regime change by the Bank of Japan. Bank of Japan apparently is saying we still thought that was an accommodative policy. We didn't think raising the rates to 25 basis points was that big a deal. The market certainly perceived it. And as I mentioned, sort of the unwind of that carry trade being a precipitating factor. So I don't think we'll see the quite kind of that immediate volatility. Markets going down 12% in a day is scary to anybody. But what I think we will see is a continuation in the slowing of economic growth that we had been seeing. The second quarter U.S. GDP was much higher than expectations. But if we look at the year before, it's half of what the year before was. So we are seeing that slowing. It's going to sort of continue to slow.
Cheryl, always a pleasure. Thank you for making time to chat with us here on Daybreak Asia. She is Cheryl Smith, economist and portfolio manager at Trillium Asset Management. Nicola, she is M-LIV macro strategist. She's in Singapore, and so Mary and I are going to chat a little bit now about what's happening in markets. Can we start with this inflation data for China? Does it shock you that I don't even know how many months it's been since kind of factory gate prices have been in deflation? This is problematic, isn't it?
Absolutely. I think we've seen that there's just a broad weakness in the domestic economy, whether you're seeing it from consumer price indexes or from the producer price index. Both are suggesting that domestic demand is very, very lackluster. And of course, adding to that is the weak export data that we saw, and exports were one of the big drivers of growth for China for some time. And now that that's losing steam as well, it's hard to see China really making that 5% growth target.
I know it's a very sensitive topic around the notion of overcapacity, but isn't that part of the problem where there is so much capacity that some of these producers have no choice to move inventory but to lower prices? Isn't that part of the problem?
Well, it's also a problem of domestic demand. So it's the fact that people aren't responding to these lower prices. It's a matter of there is a weakness in domestic demand, so they're forced to export as well, which is why we've seen a massive uptick in exports in things like electric vehicles and other stuff. So it's a combination. It's really, if you pin it back and draw it back to what is the underlying problem, it still comes back to the weakness in domestic demand, and that's largely because of what we're seeing in the property sector. So
where does that leave the government, particularly the central bank? Is there anything that can happen on the policy side? I know that we've seen rate cuts and rate cuts. Nothing seems to work. I know a while ago we were talking about some form of quantitative easing, but PBOC seems a little resistant. What can policymakers do?
Yeah, I think it still comes down to what will they do on the property sector. We have to remember that so many people have their money in property in China. And now that the property sector is been in a malaise for such a long time, there is concern about where to put your money and will this market ever come back? So it's still, and we have to remember how much the market reacted to the possibility of cleaning up that excess supply. But of course, it wasn't enough, and it didn't do much to pick up sentiment because it wasn't a big surprise or a big comprehensive plan.
What do you see when you look at the Chinese bond market right now as one example? Is there anything that is informative about kind of investor sentiment when you look at Chinese bonds?
Yeah, it's interesting because a while ago I had written something specifically talking about China bonds and the Japanification of China bonds, in the sense of that yields are going to continue to go lower, largely on the basis of longer term prospects of demographics, debt, deflation, and depressed confidence. And a lot of these factors haven't really changed, which suggests that yields should be still heading lower as a result.
In terms of the currency, do you have a sense? I mean, we've been holding around these levels for, it seems, quite some time, and we talked about the export component being very important for contained, or rather continued, growth in China. Do you have a sense of whether or not authorities are worried about weakness in the currency?
I think we've seen a strength in the currency with the unwind of carry trades over the last week. So China was one of the big funders that investors were using. So we've seen that unwind come through for CNY. But at the same time, and that actually the yield differential narrowing with the U.S. does provide some opportunity for the PBOC to actually move ahead on interest rate cuts, because if you recall, they had been focused on the weakness in the currency and were reluctant to cut rates because of the fear of capital outflows, because of an overshoot in currency weakness.
Yeah, we can talk a little bit about the yen trade very briefly. That was pretty stunning. Do you have a sense, I mean, your sources, the people that you're talking to in the newsroom and their sources, do we have a sense that most of this unwind has happened already?
Yeah, the big story was from JP Morgan, where their estimates show that 70% of the carry trade unwind has already happened. But potentially, we're looking for yen at trading into a new range, right? So the possibility of dollar yen going back to 160 is very unlikely, especially with a relatively hawkish BOJ. So we could see yen stabilize around these levels, but with heightened volatility, you could still see a further unwind in the carry trade.
Eva Lee, she is head of Greater China Equities at UBS Global Wealth Management, where she is in the Chief Investment Office. Pleasure to have you on the show today, Eva. Thanks so much. So much has been happening in global markets. I want to get into the China story momentarily, but I'm curious as to what you're hearing from clients as a result of this enormous volatility that was running through global markets in the past week. What were they saying to you?
Well, luckily, most of my clients actually have been sitting their money in the money market funds, in deposits. So they're actually looking into when's the best timing to deploy this cash. Some of them actually have their holdings already in bonds, and they're happy, with the movements. If you look at the past 2 weeks, the investment grade bonds has been doing well. So the biggest questions that I've been asked is whether the yen unwinding it's done. I think that's the key questions. And based on our data analysis, we find that, that if you break it down in terms of the yen positioning into 3 buckets, and the more near-term buckets, the unwinding already done. And I think this is an important signal, because I'm not saying that there won't be any volatility. There will be. I mean, we look at how the U.S. market overnight, and going forward, we still have a lot of data to sort of signal where the U.S. economy is heading. But having said that, some of the markets after the corrections, like the big tech, the quality companies, some of the Japanese ones, they look really attractive in terms of valuations after the correction. Yeah, I think that's makes some, sort of the equity market very interesting, at least in the near term.
So, Eva, we've seen over the past week that there has been this view that China has been a safe haven. What do you think that is? And also, what do you think will be the real catalyst that brings foreign investors back, especially since we've seen a number of different policy responses, but nothing has really compelled foreign investors back in? So what do you think it'll take?
I think the market really, I'm totally with you. I mean, some of the trade program on home appliances, I'm like, hey, come on. I mean, the central government is pulling out real money to support the economy. It hasn't happened often. The last time it did so was 2009, I think. But having said that, I think the market really needs real data, or, sort of real earnings improvements to sort of pull the market in, pull the money back in. I think there was select companies' earnings results surprise on the upside, despite the very challenging macro. They're still able to grow their earnings by teens, and the share price up 10% in one day. I think so. Market did respond, but they need real data. They no longer will listen to that's policy support. I think that's the main difference. And obviously, people have been hiding. I won't describe China as a safe haven, but I would say there are pockets of sectors that give you yields, and they still trading a very attractive valuation. I think that might be where people are hiding.
The export economy seems to be holding up remarkably well, even though Caixin, the last reading on the manufacturing PMI was a little soft. I understand that. But if you look at the overall economy, domestic demand is very sluggish. We get that. Exports are holding well. Here is the sword of Damocles that's just dangling over the market, and that's the tariff story when you consider geopolitics and the U.S. I mean, are you braced for something in a new administration where we could be potentially looking at much harsher tariffs on Chinese exports?
I think we all understand. I mean, the, sort of the Republicans, Trump, it's more likely to be harsh on China, particularly on tariff side. We don't know too much about Harris at the moment, but looks like the Democratic Party would be more of a continuity of policy, i.e. they will continue on these restrictions on EV, but they're not going to impose new additional ones onto China. But I think you brought a very good point. It's, yes, export growth was very strong, but we cannot deny that part of it's people are making orders ahead of this potential change in tariff. So further down the road, particularly moving in 2025, these sort of teens growth in export, it's unlikely to continue. Then it will fall back down to local consumptions. And as consumption was so weak at this stage, in fact, it tells you why the government really pull out their own money to support the economy, domestic consumption, because they knew that if they do not drive this further or let it, sort of live and kicking, the export growth, it's not going to be there forever. And then the economic situation will be very challenging moving into 2025.
Eva, you spoke about earnings. What are your expectations for this earnings season, and how do you see the tech companies playing out?
Overall, will be a mixed bag. Like, we all know that the top line, particularly the consumption side, is very weak. I mean, when we break it down into details, so for those that announce results, they're all saying ASP down. So the only way is they're able to manage volumes and cost control. Then they're able to do some magic on the bottom line. So not all the companies manage to do that, right? So that's one point. Second point, on the internet side, leading internet companies likely to continue to surprise you on the bottom line, on the cost control. They did that in first quarter, and I think that will continue in the second quarter. And they will confirm you more of the buyback plan, which they have done in first quarter. So we actually see that this could be, at least make some of these stocks look more interesting around the results season.
I'm imagining that you don't believe that we're going to they hit the growth target this year. I think you're probably of the opinion that we're going to fail on that front. Am I right?
Okay, they said 5%. Okay, now the broad saying it's as long as close to 5, we are good. So I don't know how you define whether
do you have a guess?
Target or not.
Take a shot.
I think 4.6, 4.7, 4.8. I think that would be the rough target they will reach.
All right. Eva, it's always a pleasure. Thanks for making time to chat with us. Eva Lee, she is head of Greater China Equities at UBS Global Wealth Management. She's part of the Chief Investment Office in Hong Kong. This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.